FSB. FSB.
Hello and welcome to this FSB webinar. Today we are going to be focusing on how managing working capital is crucial for the financial health and cash flow of your business. My name is Sian Brennan-Todd. I will be your host here today, and I am a very proud FSB member. I moved back from Australia last year and very quickly became an FSB member, because I could see the wonderful benefits that joining the FSB was going to give me. There's fantastic networking availability. I was meeting so many businesses that perhaps I wouldn't have met before. And the support was absolutely vital for me when I started my small business. So we're thrilled to have you here with us this morning. I've got a great expert panel who are going to be joining us in a little bit. But the four main areas we're going to be covering today are what drives the demand for working capital finance and how the market has evolved, because everything is changing at the moment, and it's really good to speak to experts to find out how we can benefit our businesses the best. The second point we're going to be looking at is what types of working capital lenders are out there. For some of us, it can be a little bit confusing and a bit of a minefield. So we've got our experts here to really help us hone down what could be the best and benefit us the most. The third area we're going to be looking at is the many types of working capital finance solution and how these can differ. We've all seen there's many and a big variety out there. There's many different ways we can look at this. So our experts will be helping us as small businesses decide the best way. And the last point is how we can navigate this diverse and complex lending market. So if you're confused, if you're not quite sure, as a small business, this is the webinar for you. And we will be sending out links and an email after the end of this webinar. So if there's anything that you would like to hear more about, we will be sending that out. We, as the FSB, are here to help and support you. And that's exactly what we hope to do today on this webinar. Now, I'm going to introduce our first speaker, and I'm thrilled that our first expert joining us is Natalie Gasson-McKinley, MBE. Now, Natalie is a senior manager for policy and strategy at the British Business Bank. Now, I asked Natalie for a couple of tips and tricks, and she said that she's going to help fill us all in and help all of us today on this webinar. And Natalie, congratulations on your award for the New Year's 2023 honours, getting your MBE for services to business in the East Midlands. Natalie, welcome, and we look forward to hearing from you now.
Thank you, Sian, and it's a real pleasure to be here today representing the British Business Bank, but also working alongside yourself, the FSB and Alica Bank. So first of all, a warm welcome to Business Finance Week. So for anyone who isn't aware of what business finance is or who the British Business Bank are, then that's really what I'll just start by saying. So I'm Natalie. I'm a senior manager within the bank's policy and strategy team, and the bank have 4 strategic objectives, one of which is unlocking potential, and that's the objective I lead on. So basically it means ensuring small businesses have access to finance regardless of where they are or who they are. So it's a great agenda for me to have. And part of that is actually working with our UK network team to ensure businesses know who we are, can access our finance hub. So it's a real pleasure to be here today. Also, just to say, it's our 10-year anniversary this year. So I know FSB is celebrating 50 years. We're not quite there yet, but hopefully we will be not far behind you. And so a really great year for the bank in general. Over the 10-year period, we've supported hundreds and thousands of small businesses just like yourself. So British Business Finance Week is one of the ways that we can showcase some of the products and the services that we have. So also really important to let you know, if you don't know, we're the UK's Economic Development Bank. So we are a government bank, but we act independently. And ultimately, our remit from government is to help break down barriers for smaller businesses to access finance. We do this in a range of ways. So we have startup products and services, scale-up products and services, and stay ahead. So you can see there a catalogue of some of the finance options that we have. Some of those I'll talk to you in a little bit more detail with Sian as we go through the course of this webinar. So don't worry about memorising that list, and also we'll share some links so you can access all of that. So Business Finance Week, we have a number of key themes. The one we're going to be looking at today is managing your working capital, as set out by Sian. So as part of that, I'll talk to you a little bit about the debt products that we have at the bank, our equity products, and again, some of the softer ecosystem support access that you can find as part of that. So again, really delighted to be here. I did work at the FSB for over a decade, so great to be back and great to be supporting this event. Thank you. Oh, sorry, this is also a finance guide that you can access. So don't worry if you're not quick with your phone and you can't take this QR code. We will be sharing links afterwards.
Thank you so much, Natalie. That is great. And I have to ask, for your 10-year anniversary, did you celebrate? What was the celebrations that the bank was able to have?
So they're all scheduled for November. So at the moment, we're quite, different teams have different functions, but within the bank at the moment, we're quite focused on spending review. So I'm looking forward to hopefully having a slice of cake and something fizzy in November, because it feels like a tough slog at the moment. All really worthwhile, but yeah, there's a lot of preparation happening at the bank behind the scenes currently.
And you talked about being part of the FSB for such a long period of time. Can I just ask you, what were the highlights for you working with the FSB?
It was really making a difference. So anyone who knows me at the FSB, or anyone who's on the call who might have met me previously, my dad ran a small business, my husband ran a small business, and FSB really is at the heart of that. You know, there's so many things, keeping trade local, small is beautiful. You know, we know that small businesses are the hearts of those communities. They create employment, they create wealth. Very often those furthest from the labour market can find their first employment in a small business. But on top of that, you know, let's not forget the scale. I think when I was at the FSB, it was about 5.5 million small businesses in the UK economy. So that's a huge powerhouse. And so lots of highlights, working with the development manager team, so the field staff, the policy and strategy team that the FSB have. Everyone's fantastic. So lots of highlights.
Brilliant. Well, thank you very much. We look forward to picking up on a few of those points in detail later on. Thank you very much, Natalie. And I'd like to introduce our second speaker. So we have Conrad Ford, who is the Chief Product and Strategy Officer at Alika Bank. Now, Conrad is here to answer very specific questions which we have as small businesses. But I will hand over to you, Conrad, to just give us a little bit of insight as to you and Alika Bank.
Hi, everyone, and thank you for coming along, and really nice to be here. So yes, Alika Bank is a bank focused on established businesses. So we're a bank just solely focused on helping those businesses around the country, which we think aren't massively well served by the big banks. Proud to say we're a partner of the FSB, a recent partner of the FSB, but we actually have a relationship going back quite a long way, because we've worked very closely with the FSB in the past and recent times around making sure that the government and Bank of England and other key stakeholders take the right stance in terms of access to finance for SMEs, which is crucial, of course, to the real economy that we all know and love around the country. And we're actually a delivery partner as well of the British Business Bank. So the British Business Bank doesn't work directly with SMEs per se. We're one of their many finance providers that they work with. For example, we are involved in the Growth Guarantee Scheme, which is the scheme that they have to make finance more accessible for SMEs. So we're very pleased to work with the British Business Bank as well. before Alika, and probably most relevantly to the conversation we're going to have today, I actually founded what is the UK's leading comparison service for small business lending. So I am actually, like the people who are listening to this, I was a small business owner and ultimately a fairly big business, but it started off with me in my bedroom. So I've kind of been through the journey that we've all been through as business owners. And actually that business, because it was a comparison service for small business lending, approaching 20,000 businesses have actually raised working capital through that business. So I've lived and breathed the market that we're going to be talking about. So without further ado, I'll give a bit of an introduction to working capital finance and set the scene for some of the conversations we're going to have and the questions we'll have later. So let me first talk a bit about things to think about when you're thinking about working capital finance. And I've got my Conrad's 5 C's here. So I think there's 5 major areas for businesses to think about when they're thinking about working capital finance. What I'll do is I'll talk through some things to think about, and then I'll also give one key takeaway for each. In other words, if you're going to remember one thing, remember this. So the first one is circumstances. So there are many drivers of why you might need working capital finance. You might be a seasonal business, for example, a hotel that is low on cash in March before the summer season that kicks off. Or if you're a shop, you may well be have a need for capital in the run up to Christmas because you're buying stock and then you've got your busy sales season. One of the key reasons for working capital finance is turnaround. In other words, that the business has run into challenges. You might have lost a major client or something. And my one key takeaway on circumstances is around turnaround. So if you're a large business and you've got specialist lenders and specialist advisors helping you with finance, who can really get under the bare bones of your business plan before they provide finance. The phrase that gets used in the industry is management actions. Management actions is what are you going to do to change the situation of the business to get yourself out of the situation that's led to the need for finance. And unfortunately for smaller businesses, you're not surrounded by expert advisors, and the lenders probably don't have time to get under the skin of your business plan. So it's really important if you're going to raise money to turn around your business, for example, if you've lost a large contract, have a really clear plan of how you're actually going to use the finance to get through the situation. For example, that might involve reducing the number of staff you have or selling off stock or selling off property. So the key point there is basically if you're using working capital finance for a turnaround situation, please avoid the situation of being in a hole and keeping digging. Have a plan. So the second thing to think about with finance is capacity. So how much finance do you need and how much finance are you going to use? So the first question to ask yourself as a business owner, I think, is have you been realistic? It's very common for businesses to not raise quite enough because there's an element of optimism in their business plan. So have you got the capacity? And then also, what's a feature of working capital is it tends to be there for when you need it. If, for example, you get an overdraft, it's there for when you need it. So are you paying for finance you're not using? So do you understand the contract? Now, it's normal to pay a bit of money, maybe perhaps a fee, for the availability of a working capital finance facility. But are you actually going to be paying a very big premium for money that you're not using if you don't need it? So that's the second consideration. My key takeaway on this is to make a point that not all businesses understand. Commercial finance, as we call it in the industry, so business lending, is largely unregulated. So if you're, in particular, if you're a limited company, incorporated company, then generally speaking, finance provided to you is unregulated. So we kind of, as consumers, we get used to having highly regulated financial services, and something that most of you will have seen is key facts. So if you're buying insurance or you're getting a mortgage on your home, you'll get a key facts document that states in really crystal clear term the fees and conditions, and also makes it very easy for you to compare between options. You won't get a key facts document in this market because it's largely unregulated. So it's quite important to get under the skin of it and don't take a kind of leap of faith that everything will be okay. So the third thing to think about in working capital finance, I think, is cost. Now, cost, of course, is a consideration, but it can be quite complicated in this market because there's a whole host of ways that you're paying for your facility and working capital. So the first one, of course, is interest. So in other words, you'll typically pay an interest rate on your balances. But very often that will be only part of the, well, usually that will be part of it, and actually sometimes a relatively small part. There will typically be upfront fees, very commonly called arrangement fees. So how much you pay to get the facility. There may be service fees, fees to have the facility available, for example, an overdraft, those are ongoing. And then termination fees, in other words, at the end of the facility. My one key takeaway on cost is because, again, it's largely an unregulated market. Do you understand how much it will cost you if things go wrong? because the less reputable providers in the market, and there are some, let's be clear, they will often take advantage of a situation where you can't pay back. In other words, if you can't pay back on the terms that you agreed to, then that's when things start costing you a lot of money, and you don't necessarily have the protection of a regulator. So again, do you really understand the cost of your facility if things go wrong? Then we have commitment, number 4. So commitment, so firstly, read the small print. And if it's a meaningful amount of money to you, please do get legal advice. You know, if Richard Branson was borrowing £500,000 for one of his businesses, he can probably afford for things to go wrong and not without lawyers being involved. But the chances are, if you're anything like me, you couldn't. Yeah. So please do get legal advice if necessary, if it's a large amount of money for you. And also on the other side, do you understand the level of work involved to maintain the facility? Some types of working capital finance are admin intensive. It comes with the package. My key takeaway on commitment is personal guarantees. So what is a personal guarantee? If you have a limited company where it's meant to be separate from you as an individual, a personal guarantee is a way of you saying you're personally liable for the amount of money that's being borrowed by your company. So in other words, the protection of limited liability, for those that want the technical term, is to some extent stripped away by a personal guarantee. So it's really important to understand the concept of a personal guarantee. For example, a common phrase in our jargon-heavy industry is PPRs, principal private residence. That is your home. So in some cases, a personal guarantee means that because of a business debt, you're putting your own home on the line. So it's super important that you understand that. And that's why I say, please do read the small print and get legal advice if necessary. Finally, certainty. So there's a phrase in our industry that some cynical business owners say that some of the banks will give you an umbrella when it's not raining and take it away when it rains. Now, I won't comment on whether that's fair or not, but it's a good illustration of how to think about this. It's quite possible, for example, that you'll have an overdraft up until the point that you need an overdraft, at which point it mysteriously disappears. Now, we saw this actually after the global financial crisis. We had a collapse in overdrafts to businesses. About £5 million a day of overdrafts were taken out of the market over a period of a number of years after the global financial crisis. And it's quite easy to do that, to take away an overdraft. For example, if it's an overdraft to a hotel, the lender will know that you are probably cash rich at the end of the summer trading season. So that's when you receive a letter saying there's no more overdraft, because at that point in time, you don't need it. So do you understand the level of commitment from the lender to you? How much certainty is there? Because working capital finance is for when you need it. So those are 5 considerations that I wanted to pick. Let me just briefly also touch on the types of working capital finance there are in the market. Just bear with me, please. So what types of working capital finance? Now, I've put at the bottom here, PS, there are more. I could spend 2 or 3 hours telling you about the many types of working capital finance. It's not an overstatement to say there's dozens of types of products. But I've kind of pulled out here what I think are the most common ones and the major ones to know about. So the first one is something we'll all understand, business overdrafts. They're not fundamentally different to personal overdrafts and how they work. I just re-emphasize the point that I made earlier. They are far less available than they were before the global financial crisis. There's some very technical reasons for that, but they're not going to go away. They relate to how banks have to store money against unpaid debts. So business overdrafts, they are harder to get than they have been historically. And the other thing, as I touched on before, it's quite easy for a lender to take an overdraft away at just the point you need it. So business overdrafts is kind of area number 1, but certainly an easy thing a relatively easy product to manage. So the second one is business credit cards. Again, you'll all understand what that means. It's not massively different to a personal credit card. Why business credit cards? Well, there's one fundamental reason to use a business credit card over a personal credit card. And that's that if you have a limited company, an incorporated company, the debt is against your company. It's not against you personally. So that's one fundamental reason. And it's a really important insight, by the way, because believe it or not, the most common form of finance for small businesses is personal credit cards. So they're personally liable for their business debts. There's other reasons you might want a business credit card over using a personal credit card for your business, by the way. You'll typically get rewards that are relevant to your business, for example, savings on key business items. And then also you'll typically get integration with things like your accounting software to make your life easier. So there are good reasons to use a business credit card over a personal credit card, but let's just say it's lots of businesses use a personal credit card. It's just a fact. Then we have unsecured loans. So secured is a lender phrase. It means what we actually have as an asset against which we can actually secure the loan in the event you can't repay. Unsecured loan works very simply. You typically pay a fixed regular amount as you would with a personal loan. But something to be really important here is unsecured loans very often rely on a personal guarantee. Okay, so very often and very commonly, there's a requirement that you as a business owner are putting your personal assets, in some cases your own home, against the loan. So don't be tricked by the term unsecured loan. If there's a personal guarantee, it's secured in your personal assets. And again, legal advice necessary. Then a newer type of loan that's only really arisen in the last 10 years or so. And this is focused on business to consumer businesses. And I've used the term revenue loans, but kind of market examples you'll see. The first is called a merchant cash advance. So if you're a business that uses card payment terminals on a heavy basis, it could be a shop or a hotel or a restaurant, then you can get a loan against the money coming in your payment terminal. And actually you repay as a percentage of the amount you take on your terminal. So a nice advantage of that lending type is if your revenues dip a bit, then your repayments dip a bit, but it can be quite expensive. Much newer is loans for e-commerce businesses, which work on a similar basis. You repay as a percentage of revenue. So that's a relatively new type of loan, innovative loan. It's been a really good way of buying stock, for example, for successful businesses, albeit it can be quite expensive. Then we have invoice finance, and I could spend an entire hour speaking about invoice finance. It's a very complex market, but the overall principle is really simple. If you're a B2B business, typically, who raise invoices that are then paid later, so you may raise invoices and say, you pay me in 30 days, and let's be blunt, that probably means you're actually going to get paid in 45 days if you're lucky, then you can actually release the cash in those unpaid invoices. Now, there's lots of different variants of invoice finance, and as I said before, I could spend a lot of time talking about it, but fundamentally, there's two fundamental variants. One is factoring, where the lender takes over credit control for you. In other words, they collect on your invoices. The other is invoice discounting, where you stay in control of doing that. There is advantages to factoring, for example, somebody else is doing the admin for you. But invoice finance is a complex market, but it's a very established market. It's been around arguably for centuries. And then finally, asset-based lending. So this is quite rarefied. It tends to be larger ticket lending, typically above £500,000. So you have to be quite a good business. Quite a large business to be able to access this type of finance, but it releases cash from a mix of your assets. So you may have vans, property, invoices, stock. It releases finance from a range of assets. It's a kind of specialized bespoke lending, but if you're a larger business or a high growth business, it can be a really effective way of actually releasing some working capital in your business and allowing you to keep growing. So hopefully that was a great, a useful whistle-stop tour of the working capital finance market and considerations. Before we get into the discussion, and really looking forward to hearing any questions you have as well. So thank you very much.
Thank you, Conrad. That was great. And I loved Conrad's 5 C's. That was good. I like 5 C's, anything I can remember. And I think what's great is you have obviously yourself been on a journey of starting a small business. So you understand the impact that all of these variety of things that you're talking about can have on small businesses and needing a plan. And I'd just like to ask you, what types of working capital finance providers are there in the market and who does what? It's very varied. It's huge. For small businesses, they might not have the time to go and research everyone. Can you just sort of tell us a little bit more in detail about the providers out there and who is doing what for small businesses?
Yeah, absolutely. So let's talk about the types of lender out there firstly. And in our world, which is a very jargon-filled work and very technical world, we often talk about 3 tiers or 4 tiers in the market. So tier 1 is the big high street banks. We all know who they are, the big high street names. So why are they called tier 1? And the reason they get called tier 1, again, within our industry, not externally, is because they have access to very cheap money to lend. And the reason for that is because they have lots of money floating around in current accounts from you and me, and which they don't pay interest. So what does it mean to be tier one? They typically do very simple and larger prime lending, and prime basically means easy. It's no-brainer, let's call it no-brainer lending. So the large high street banks, they'll most commonly be lending to their own customers. Although that's not the case in every case. There are some examples that have quite large direct lending divisions. They tend to think of the working capital finance products as specialist lending. So their core is doing mortgages. Frankly, that's the vast majority of the lending that they do, whether to businesses or to ordinary people. But it tends to be relatively simple. And over the last decade or so, they've pulled back a bit from what they call specialist lending. So some of them have shut down some divisions that did specialist types of lending, and some have sold them. Or just gone slightly up in terms of the size of business that they serve. So that's the tier one, but the big high street banks are still the large, almost the largest providers of finance collectively. The second category, or tier two, is specialist and challenger banks. So that's what I would call Alika, by the way. So we are not a big high street bank. We don't have branches, but we are now quite a big bank without branches. We are much more likely to be doing those kind of specialist lending products, which support working capital to SMEs, to small businesses. And indeed, we only exist for small businesses. So we offer quite a wide range, but we're not the only one. Now, fun fact, the majority of SME or small business lending is now done by specialist and challenger banks. Now, if you told me that would be the case 10 years ago, I would have not believed you. Yeah, having been in this market a long time. The kind of dominant narrative of my lifetime, and actually my parents' lifetime too, actually, is that the big high street banks dominate lending, particularly to small businesses. But it's turned out that in the last 10 years, we've seen a huge marked shift. And actually the support of the British Business Bank has been quite integral to that, by the way. It's great for the market, and all participants would say it's great, including the big banks, because it's opened up more choice and more opportunity and more niches. So you've got specialist and challenger banks. And then you've got non-bank lenders. So these are not banks. Yeah, they often get called by customers banks, but they're not banks. And if they said they were banks, they would go to prison. Non-bank lenders have to borrow their money that they lend. So they tend to have more expensive money to lend. So they tend to operate in more specialist niches. And they tend to serve customers that are typically less easy to lend to for a number of reasons. It may be very complex. It may be that the customers had issues, for example, like a county court judgment. So the non-bank lender segment. But collectively, to be clear, there's a huge range of lenders in the market. There's probably around 200 working capital lenders to SMEs in the UK. And that's probably an understatement, by the way. So there's a huge range, but generally speaking, think the very big high street banks, the specialist and challenger banks, the non-bank lenders. That's the big three categories.
Brilliant. Thank you very much for clearing that up. And Natalie, I'd like to bring you in here. Can you share some more details about the different finance options available through the British Business Bank? And how can small businesses determine which is the best fit for them?
Yes, absolutely, Sian. And I think it's worth saying one of the beauties of business finance, because it's exactly why we do this. It's about demystifying, and Conrad there has very expertly taken listeners and viewers through for a range of options. But in terms of the British Business Bank, again, as Conrad said, we work with over 200 delivery partners. So our role isn't to change or impact the market to an extent where it acts differently. It's to facilitate change and plug those access to finance gaps. And because of that, we have a range of finance options which are tailored to the needs of small businesses. So starting with our startup loans programme, which is a debt product. We have equity finance, working capital solutions, and really for anybody listening or watching today, the best way to find out which of those options is best for them is to visit our finance hub, where we've got a range of guides, toolkits to help businesses make informed decisions. But to take some of those products roughly, and this is a really rough guide, typically with our startup loans, they go up to £25,000. So if you're a startup business, you have to be under 2 years to access that programme. We also have angel investment. Typically, an investment of that size is £15,000 to £2 million. We have venture capital solutions as well. So you're looking at £2 million to £20 million investment. expansion capital as well, and that's 5 million to 100 million. So this is why it's really important for anybody looking to access finance to understand some of what Conrad's talked to today, is understand why the capital is needed and what's the long-term plan and investment to use that capital most wisely.
And you talked about the hubs that you run. Can you just expand on that, please, for anybody watching?
Yeah, absolutely. So we have an online finance hub. On there, you can go through a three-step. I'd say it's like a three-step. It asks questions. It's using algorithms and lots of other things. So the other thing I will say is we have a UK network team who are based very much like the FSB's development managers. So in a local area, our UK network are really our feet on the ground, so they can impact and work with local organisations like the FSB and the Chamber of Commerce. So that's the person who might turn up at an FSB event or an MCA event, a mayoral combined authority type event. But ultimately, they can explain some of the bank's solutions, but they're not always accessible. So we have an online finance hub where you can go as a business, go through this three-step process, and it will give you a couple of options in terms of the different products we have. But also, really importantly, it has a range of guides and toolkits from entry-level access to finance questions right up to some of the more technical detail that somebody would want to ask. So I'd always say to anybody, if you're new to the bank, that's your first starting point.
Great, thank you, Natalie. And Conrad, can I ask you, how are working capital products priced, and what factors beyond price should we be all considering as small businesses?
Yeah, so in terms of pricing, I mean, I briefly touched on this before, but let me go into a bit more depth. So, I mean, firstly, I think pretty much every product will have an interest rate. So we all understand the concept of an interest rate, but one of the reasons they'll have an interest rate is because the costs of the money that they are using to lend to you is influenced heavily by the cost of money in the outside world, and above all else, the Bank of England base rate. So the interest cost has gone up on average significantly in the last couple of years. We had a very strange period. So the period of what they call the zero interest rates, it wasn't quite zero, but the very low interest rates after the global financial crisis had never happened in the entire history of the Bank of England. And you can imagine that goes back many centuries. So the 10 years or so we had before the recent spike in interest rates was very, very abnormal. Yeah. Or to put it another way, interest rates going up to what they are now, 5%, is kind of return to normal interest rates. And we shouldn't forget that. You know, if you're of my age, if you've been around a bit, then you've seen quite a lot higher than that actually in my lifetime, 1.15%, I believe. So interest rates, of course, is a major factor in the cost of finance. But one of the things I really wanted to emphasize, that in working capital specifically, it can often be actually in the ends, when you think about what's called the total cost of ownership in management speak, can often interest can end up being the minority of the lending cost. Now, that's not the case, for example, if I'm going to get a 30-year mortgage on my home. Clearly, interest is by far the biggest thing. I'll pay a little fee at the end, a little fee at the start, but the reality is my interest rate is going to absolutely dominate the cost of my finance. But in working capital, because it's shorter term and it's more complex, then very often other types of fees actually end up being the majority of the cost in aggregate. So arrangement fees is the first one, very simple to understand. You may have to pay, for example, 5% on day one. It may be 1%, but it's obviously easy to understand. They'll often be service fees during the life of the loan. That's very common, where you're basically paying to have the option to take money whenever you need it, which is what working capital is, right? So you will often arrange a facility well in advance of needing the money. In fact, that's good practice, is it not? Well, you pay for the option. So a service fee is very common on an overdraft, on invoice finance facilities. And it's understandable, right? Because there's a cost for giving the facility that doesn't get used. But the thing I'd really want to pay attention to is what happens if things go wrong. Because the less reputable lenders will, bluntly, they will gouge customers when things go wrong. So in other words, if you breach what they would call a covenant, In other words, one of the things that you've committed. It may be to repay, simple as that, but there may well be other covenants. If you breach a covenant, then suddenly things can get very expensive very quickly. And that's why I say please always read the small print. And remember, you won't get a key facts document so that you can compare like with like. So it's, you know, the unfortunate reality is, as a small business owner, you're expected to read the contracts in a way that consumers wouldn't necessarily be expected to and have a level of protection. So that's my advice.
I think that's really useful. As you're saying, not everybody is in tune as much as someone like yourself. So these crucial tips are really helpful. And can you elaborate a little bit on the importance of working capital for growing businesses and the options available to help manage cash flow effectively? Because we know this is something that comes up time and time again with small businesses. Can you give sort of some tips on that and some advice to small businesses?
Yeah, absolutely. And believe it or not, back in my past, I qualified as an accountant, so I'm still an accountant. So I'm going right back to my accountancy qualification here. So there's what's very commonly called the working capital cycle amongst accountants and people into that sort of thing. So the working capital cycle is basically the process that takes you from building or buying whatever it is you sell and selling it and getting the money through the door. Now, the easiest example to give is a business-to-business manufacturer. So most manufacturers don't sell directly. They'll sell to a warehouse or they'll sell to shops and they'll do the selling. Now, the working capital cycle of a manufacturer can be very long indeed, because they will need to buy the raw materials that they're going to build stuff with. They're going to need to pay the staff to build it and all the overheads like the building, the heating, etc. So they have to pay the period for the raw materials, making those into manufactured products. And then if they sell it onto a warehouse or a warehouser or cash and carry or a retailer, then they will typically do that on credit. In other words, they won't receive payments immediately. They'll say, you pay us in 30 days time. And unfortunately, very often they get paid later than 30 days. So it can be the case that from that first buying of the stock to selling it, getting cash from the end customer, that retailer or cash and carry, can be as much as half the year. Okay, so that is the working capital cycle. Now, why does that matter? If you're growing quickly, then unfortunately, some of the highest growth, most high potential businesses can get into the most problems with working capital because they start burning cash at the start of the working capital cycle, and the cash coming in at the end is still many weeks or months away. Okay, so the working capital cycle and understanding that for your business is really, really critical, because unfortunately, very often, really great businesses, high growth businesses actually get into cash flow trouble because they mistake profit and cash flow, which are two very different things. So the advice is be on top, understand your working capital cycle, and frankly, be on top of your cash flow forecasts. You know, kind of understand when you expect to get cash in the door. Be a bit conservative. You know, perhaps they're going to pay you a bit late because they're being paid a bit late by somebody else. So understand your working capital cycle, be a bit conservative, and then get appropriate finance for that. And the earlier you act on getting finance, the less likely you are to firstly pay too much for it, and secondly also to sign up to terms that end up really hurting you in the long term. So being thoughtful and planning ahead. Now let me just be open, right? I'm a qualified accountant, and I've stood on many conference stages lecturing small businesses on doing cash flow forecasts, which is best practice. When I was building my own business, did I? No, because customers got in the way and reality got in the way. I did occasionally get around to it, and I got to a certain scale and I had a finance professional doing that for me. So it's easy to say this, but if you're a high growth business, then commit to your future and actually get a professional to actually do that for you, because otherwise it's probably going to cost you a lot more money or a lot worse. That's my advice.
That's great. And I've actually got a question here, Natalie. I'm going to ask you from Julie. And Julie asks, are there any banks who are more likely to allow overdrafts to a business with a good financial profile?
Oh, so I'll be really honest and say, because we work through delivery partners, that wouldn't be a question I could answer. And ultimately, this is why the Finance Hub is so important. So we often say when people are looking to access finance and go through the Finance Hub, it will bring up a range of delivery partners to suit needs. And very much, whilst we don't have that sense of a bank manager, and to Conrad's point, this is why challenger banks are doing so well in the market currently, because very often some of the more creative ways of actually having those relationships are being met through challenger banks. So my advice to Julie would be to it, to have a look at the Finance Hub, have a look at some of the delivery partners, and make contact with the ones who fit her finance needs and have those conversations.
I think that's great advice. Thank you, because we're all individuals. And I know many times in business, we do business with people that we resonate with, that we can get along with. So doing a bit of shopping around, I think, is always really good advice. And Natalie, just carrying on from that, what advice do you have for startups that are looking to access funding for the very first time? And how can the British Business Bank Startup Loan Programme help them with that process? Because it's quite daunting when you're starting up a business for the first time. There's a lot of work that's going involved. You're wearing many, many hats. How can you guys help them out with that?
It's a great question, and it's a really important one. So Conrad there talks about, being from an accounting background, but when he started his business, a lot of the good practices went out of the window because he was running the business, and that really is very often with small businesses, it's at the heart of why it's so important to get that foundation right. Because I don't know any business I met at the FSB who said, I've got into this because I want to create really nice spreadsheets about my cash forecasting. That just doesn't happen. They've got into business because they want to solve a problem, or they can see a way of doing something really creatively. So with our Startup Loans Programme, the beauty of that is it really balances money, capital, debt, in terms of you can access up to £25,000, but that comes with mentoring and advice. So when you apply for startup loans, all of the things and the pain points that maybe an early stage business doesn't want to do, i.e. the business plan, the cash flow, you have to have all of those things in place to access a startup loan. And so often we hear from people who've accessed it is at the time they think, gosh, that's a lot of information I've got to give. But once they've gone through the process and once they've been allocated that guidance and that mentor, it's invaluable. It's about creating good habits early so that they can then stay ahead, they can grow their business, they can hopefully become a high growth business. So it's a really great product. We've helped over 110,000 small businesses who've accessed the support, the guidance and the finance to get their business off to the best start. So again, and I will sound like a stuck record today, go and have a look at our online finance hub, because what you'll also see is some really great guidance and articles on things such as sustainability, supply chain, recruiting, finance options, but you'll also see some great success stories. And I think that's the other thing about starting up a business. It can be really lonely. FSB have some great networking and webinar events, but actually on top of that, it's really important that you know there's light at the end of the tunnel when it becomes really tough. That forecasting is worth doing. So on the online hub as well, you can hear about some real life entrepreneurs who are doing brilliant things with their startup loans financing.
I think that's brilliant. And you're absolutely right. It can be lonely. This is one of the things I hear a lot from businesses, especially at the beginning, because they're pretty much doing everything themselves or a very, very small team. And I think what you've just said, learning from each other, hearing someone else's story, how they've had successes and failures and building on that. And that was really useful. Can you also, Natty, can you sort of explain how the businesses can tap into the innovation focused equity finance that obviously the British Business Bank offer? And you've talked about the support. What can they expect from the bank?
So in terms of our programmes, on the original slide, they were split into startup, stay ahead and scale up. So our innovation programmes are very much tailored for the next step. So you've got the great foundation. Conrad talked about high growth businesses. So typically now we're looking at equity finance. So startup loans is the debt product. And the difference in how that works is with equity finance, you're allowing someone to put capital into your business. So let's take angel investing, for example. And in exchange for that, angel investing is people's individual money, their own money. So with that, you might get some one-to-one support through that particular angel. We have a regional angels program, which is very much more about syndication. And I don't want to get too technical. Equally, I don't want to keep saying go to the finance hub. But we have some really strong programs. So to talk about the bank's regional objectives, our business objectives, one of those is driving innovation. So those products are very much around supporting and not just businesses who are doing these things really well. So again, going back to that unlocking potential, we are looking to support as well organisations, businesses outside of the Golden Triangle, so very much the Regional Angels programme. We have our Nations and Regions investment funds, which are a suite of finance options designed to get money into innovative, creative, high growth businesses. So again, with businesses of those type looking for finance, I would say you're probably going to want to maybe have a little bit more of an in-depth conversation. So on the Finance Hub, there's a regional support tab, and there what you can see is where our senior managers who work across the bank, they have a really great in-depth knowledge of the bank's different programmes. You can see which events they're at. There's, I think, don't quote me on this, I know this is being recorded, I believe there are email addresses on there. Also, a really good shout out to the FSBs. The FSB's development managers are usually really well connected to one of our senior managers from the UK network. So for those innovative, creative businesses, I'd say have a look at the Finance Hub, contact your local development manager, contact our senior managers, and they can help you whittle down that list of the delivery partners that we work with, again, to find out, you know, what do they specialise in? Are these delivery partners who are leaning towards a certain sector or a certain area? How are they making their investments? So I'd say tap into the regional support. Again, really know what your aims are. So again, I'm going to sound like a stuck record, but a lot of this is knowing, you know, being intentional about your finance decisions, being intentional about what you're going to use that working capital for, and being intentional about the relationships you're going to develop with those delivery partners.
Brilliant, thank you. And you answered Craig's question because he had asked, what is angel investment? So excellent, there you go. Conrad, I'm going to ask you a question from Michelle, which she has asked, are there things we should watch out for with invoice financing?
Yeah, I mean, let me guess a subtext here. So invoice finance, which includes factoring, invoice discounting, and various other variants, does have sometimes a bit of a reputation in the small business community as a lender of the last resort. Now, I want to be really clear about the small business part, because among larger businesses, it's endemic. So a very large proportion of business-to-business businesses will use it, businesses that raise invoices. And it's just as much associated with high growth businesses and successful businesses as it is with businesses with challenges. But there is a perception often amongst the small business community. Why is that? Well, one of the characteristics of invoice finance is that it has more of an admin overhead than most types of finance. Okay, so why is that? It's because the lender is financing your invoices, so they need to have visibility and in some cases control of the invoices. Okay, so there tends to be an admin overhead, which is why businesses will often see it as kind of like, well, I'd rather not do that unless I have to. The other reason, by the way, related to that is that factoring, a particular type of invoice finance, in factoring, the lender does the collections from your customers on your behalf. Now, I want to be really clear here. Good lenders do that really, really well. They'll probably do it a lot better than you. They do it politely, courteously, and very efficiently and effectively. So I want to be clear, again, perception, I think, is a point here rather than reality. So I think that's at the heart of the question. So what to look out for? Firstly, I kind of would like to reiterate a point I've made a couple of times. If you leave working capital finance to the last minute, then generally speaking, then the only lenders that will serve you at the last minute are ones that are less likely to be reputable. And at the very least, it's going to cost you more money. But as I said before, it may cost you a lot more than that, unfortunately. So firstly, can you plan ahead? You know, if you've won a large contract and you're a B2B business, you raise invoices on credit, then make it one of the first things you think about, not the kind of suddenly realization you're going to run out of money by Wednesday. So in other words, think ahead, as I said before, try and do some cash flow forecasts. Understand that you're going to be spending money before the money comes in on the contract, and think that through. So, but to be absolutely clear, there are perceptions around invoice finance, but it is a market that's also awash with really reputable and high quality lenders. Okay. And they, as I said before, you know, in factoring where they do the collections on your behalf, they're probably going to do a better job than you. Yeah. You know, you may worry about that, but actually many businesses think it's great that that admin pain is taken out of their lives and they can spend their time on the business, not in the business. So there's an element of, but above all else, Try and be forward thinking, try and get ahead of the curve. And that is much more likely to open up the kind of prime high quality lenders. The other piece of advice I would give here is that you don't have to go and find finance on your own. There are commercial finance brokers, as they tend to call themselves. There's also the Finance Hub. There you go. I'll mention it too. And there's bank referral scheme platforms, which is another BBB, British Business Bank. So, let me talk a bit about commercial finance brokers. Their day job is to find finance for businesses like yours. Now, there's a membership body called the NACFB, the National Association of Commercial Finance Brokers. We work very closely with them. We think we see them as a great partner of our business because we are a lender to small businesses. One option, if you're concerned about the market, is to go and speak to a few commercial finance brokers from that network, find the one that you really like and believe in, and then they will help you on that journey, because invoice finance is a complex market. Let's be clear about that. It's highly technical. I think I'm still learning, and I'm 10 years in.
Oh gosh, oh dear. What hope is there for us? And Conrad, can you just briefly explain what regulatory protections are there if your business takes out working capital finance?
Yeah, so this is a very complex point. And so I'm going to make some fairly sweeping statements, but I want to be really clear that this is a very, very nuanced point. But let me talk through some of the elements of regulation. So firstly, regulators talk about their perimeter, okay? So we all understand what a perimeter is. A regulator is basically saying that their perimeter is basically, it's not for them to decide their perimeter, it's for elected parliaments to decide their perimeter. So the perimeter for our regulator, the one that looks after financial conduct, generally speaking, ends on with limited companies, because limited companies are seen to be incorporated companies. So if you've got limited after your name, are seen to have the individuals behind the business have the protection of what's called limited liability. Okay, so generally speaking, lending to limited companies is unregulated. Now, that doesn't mean you're without any protection. For example, many lenders choose to be part of voluntary codes. So in other words, the regulators, and there is an ombudsman, which has some authority in this area. Again, a very complex and technical issue. And then I've talked about personal guarantees. And if there's one takeaway from this session from me, it's personal guarantees. Because personal guarantees is where you're potentially putting your own home on the line, even though you have a limited company that's borrowing the money. Now, there's lots of nuance. It doesn't have to be the case. That's why you have to read the small print and probably get legal advice. But basically, one of the challenges in our market is a personal guarantee can put your personal assets, including your home, at risk, even though you're doing an unregulated lending product. So it's a very nuanced issue, and legal advice or commercial finance broker from the NACFB is a good starting point, because circumstances will vary.
Brilliant. Thank you very much. Now, we've got lots of questions, so I'm going to ask you guys just to keep it brief if possible. Brian has asked, so far, we've obviously been talking about finance and obtaining external finance, but could you, Natalie, comment and advise on best practice for managing one's own profits, reinvesting that back into your business and earning interest on the profits that way?
So I think it's really important that I qualify and say I'm not a financial specialist, and the bank actually, we don't give financial advice of that nature. We offer a tailored suite of solutions. But again, to not sound like a stuck record in answering that, I'd say plan, because the whole point of today is to talk about working capital finance, which helps you absolutely manage the day-to-day running of your business, but also having that capital is about ensuring you've got those opportunities as well. So we saw in COVID that lots of businesses pivoted. So again, I know it's not answering the question. To Conrad's point, I'd say get sound financial advice. Look at all of the range of options and do the research. But again, just to qualify, that's a question like I wouldn't technically be able to answer today.
No, that's great. And your insights, both of you, it's all about being very intentional with your financial decisions and having these plans, which I think is great, because the more we reiterate that, I think the more it goes in with us for small businesses. And Natalie, can you just elaborate very slightly on the importance of that working capital for growing businesses and the options available to help manage that cash flow effectively as possible?
Absolutely, and I think that's the point. It's going back to having that plan and forecasting, but also, let's not forget we've come out of an era where actually nothing is guaranteed. So we've seen markets change, we've seen finance options change, and whilst you can't prepare for everything, very often small businesses talk about planning for the future, and that is planning for growth, but also it's planning for adverse conditions that are out of the control of businesses. So the point of working capital absolutely is to be able to manage that day to day, but also in terms of your business plan and thinking ahead, how can you creatively, but how can you also think about, what are the challenges that might be in a particular sector or at a particular time of year, whether that's flooding, whether that's things you can't predict, like an oil tanker getting stuck in a river, all of these things. But the essentials of working capital is to build that into your plans, build that into your forecasting.
And I've got final question for both of you. So I'm going to start, Conrad, for you. If you could give one piece of advice, and I know that there's a lot that we've tried to pack into this out, but if you could give one piece of advice for our small businesses who are managing their working capital and cash flow, what would that be?
So generally speaking, working capital is the availability of finance when you need it. And the best possible thing you can do is think ahead, work ahead, do your numbers ahead. Because if you wake up at 3 in the morning on Wednesday realizing you can't pay your team on Friday, then generally speaking your options are limited and they're probably not particularly palatable too. So try as much as possible to get on the front foot, because you're basically getting an option on money in the future rather than money right now is the best way to think about this.
That's brilliant. And Natalie, could I ask you the same question? That one piece of advice to take away from today?
It's a complex and daunting landscape for anyone who doesn't understand it. So find other businesses who are navigating the same questions. Use the online finance hub. Go and seek out those providers who are actually offering impartial advice that aligns with your business plans.
That's brilliant. Thank you both. And I think we can sort of see a through line here. Try to avoid being last minute. We think that's probably going to end up costing us more. We've talked about that, obviously, and then it puts you in a more of a difficult situation rather than having that choice from the get-go and thinking ahead and planning. And I know we touched on it earlier, but as a small business, that can often be difficult because we are wearing so many hats. And I just wanted to ask you, Conrad, when you sort of first started, you obviously were wearing many, many hats. How did your decision making impact, just very briefly then to now looking back? What were perhaps the things you could have slightly changed?
I thought because I was an accountant, I didn't need to get a finance profession in the business. And I certainly understood the theory of what I should be doing, but I'd never found the time. And so I would have got a finance professional earlier in the business. There's many ways of doing this. Some accounting firms effectively can be an outsourced finance function, so you don't need a full-time finance director. There's fractional finance directors. In other words, they work on a portfolio of businesses, portfolio finance directors. I would have gone earlier to that. But that's particularly important if your business is ambitious and on a really big growth trajectory. It may well be if your business is stable over time that you don't need that, but that's a particular reflection on trying to build a high growth business.
That's brilliant. Thank you very much. I think it's always great to speak to people who have started from the beginning as small businesses. We often have a lot of questions. There's a lot of different parts of our business that we're running. And with that, we are almost up. I would like to apologise to anybody whose questions we didn't quite get to. We will definitely be sending out some emails to anybody who has registered on to this webinar. So if you did register, we will be sending that out. And I would just like to say to anybody who is perhaps thinking of joining FSB, then do have a look at their website. It's fsb.org.uk. For myself, it's been a brilliant way to learn, get in touch with other businesses, and really work to help and support other businesses as well. So do have a look at FSB on all their various social media channels, LinkedIn, you can follow them. And if there's any upcoming webinars, they will all be advertised on there as well. For anyone who did register today, you will shortly receive an email, and that will have all the links and resources that we've mentioned on the webinar, plus this video again. So if you want to watch it back, see our lovely faces again, then you can watch back, because that will be sent out to you as well. And obviously, I would like to say a huge thank you for the two experts. This has been really informative. I'd like to thank Alika Bank and the British Business Bank for their support and for raising awareness really about such an important topic. This is crucial for small businesses to be thriving and surviving at the moment. And we would strongly here at the FSB urge you to visit their dedicated websites, which you will receive in that email very shortly. I would like to say a big thank you to Conrad and to Natalie. I hope you two have enjoyed it and you have yes, well, thank you very much. Your head's nodding. Thank you very much for all of your advice. We really, really appreciate it. And as we said, if there's anything that Conrad and Natalie have said, we will be putting all of that in an email to yourselves. So a huge thank you for joining us here with FSB. We hope you have a wonderful rest of your Wednesday, and we really hope to see you soon at another event. Thank you very much. Bye-bye.
Thank you.